Welcome to this explainer. Today we're breaking down a heavyweight bout between two of the most popular investing strategies out there. We want to see which one truly sets you up for a rock-solid retirement. I mean, let's be real, who doesn't love the idea of getting paid simply for owning a stock? But on the flip side, you've got those hardcore investors who swear you should just buy the entire market, sit entirely still, and wait it out for decades. Today, we're going to figure out what each of these paths actually looks like in the real world.
Okay, here's our roadmap for today. We'll start with the great investing debate, move on to decoding dividend investing, then cover the index fund strategy. After that, we'll run the $50,000 retirement test, and finally wrap up with math versus human psychology.
Let's kick things right off with Section 1, the great investing debate.
So which approach is actually right for long-term investing? Think about it. It's incredibly appealing to wake up, check your phone, and see that a massive company like Coca-Cola has just deposited a few bucks into your account. Zero extra work, no selling anything, it literally just shows up. But you have to ask yourself, is that actually better than simply buying the whole market and waiting 30 years without touching a single thing?
This highlights the core psychological contrast we're dealing with today. On one side, we have the dividend investor. This is someone looking for immediate gratification, the absolute security of cash arriving regularly without ever having to click sell. It's that classic mailbox money vibe. On the other side, we've got the so-called boring investor. Their entire strategy relies on the disciplined patience of just tracking the broad market over decades. Now, obviously, both want a secure retirement, but their daily lived experience of getting there is wildly different.
All right, let's dive into Section 2, decoding dividend investing.
When you buy a stock, you literally become a part owner of that business. And when huge, established companies, think Johnson & Johnson or Procter & Gamble, can't efficiently reinvest all their massive profits back into their own operations, they give a chunk of it back to you as cash. In fact, some of these companies have bumped up these payments every single year for over 25 years. They even have a fancy name for it, dividend aristocrats. Now, measuring that return is all about the yield. This is just the annual dividend divided by the current stock price. So, simple math, if a $100 stock pays you $4 a year, you're looking at a 4% yield.
Now, the psychological superpower of this approach is completely undeniable. Earning income without having to sell your shares means you never have to liquidate your portfolio when the market is crashing. Your portfolio might be bleeding red on paper, but hey, if that cash keeps hitting your checking account, you're going to stay a whole lot calmer, right? Plus, since strong companies actively increase their dividends over time, it acts as a phenomenal, natural hedge against inflation. Oh, and the best part? You don't even have to pick individual stocks to get in on this. You can just grab some broad distribution ETFs that hold a massive basket of dividend-paying companies and pass that regular income straight on to you.
But hold on a second. We really need to debunk a major myth right here. Dividends are absolutely not free money. I know it feels like it, but they aren't. When a company pays a dividend out to its shareholders, the underlying stock price usually drops by roughly that exact same amount. You aren't magically gaining extra overall value out of thin air in that moment. You're simply getting a piece of your investment handed back to you in the form of liquid cash.
So the crucial point to remember is that this path definitely has its downsides. For starters, dividend portfolios can easily become way too concentrated in slower-growing sectors. Think utilities, consumer staples, real estate. That means you could totally miss out on the broader economy's massive growth phases. Second, dividends are typically taxed right when you receive them. Yep, even if you reinvest them immediately. That creates this nagging tax friction that just slows down your compound interest. And finally, there's the dangerous trap of chasing deceptively high yields. If you see some company offering a 7, 8, or 9% yield, it looks amazing, right? But honestly, that often signals the company is struggling or worse, on the verge of slashing its dividend entirely.
Moving right along to Section 3, the index fund strategy.
See this tiny number? 0.03%. It is incredibly powerful. It represents the staggeringly low annual fees of some index funds. Because an index fund is just mechanically tracking a market benchmark, like the S&P 500, you aren't paying the salaries of a team of expensive professionals trying to beat the market. This tiny fraction of a percent is a massive contrast to the roughly 1% fee you often see with actively managed funds. And let me tell you, over a 30-year investing timeline, avoiding that 1% fee saves you an unbelievable amount of money that gets to stay right in your portfolio and keep compounding.
Look, mathematically speaking, index funds absolutely shine for a few key reasons. By buying just a single fund, you instantly get automatic, broad diversification across hundreds of top companies. That means one single failing stock won't tank your life savings. They cost practically nothing to hold, and since they aren't constantly trading in and out of positions, they're highly tax efficient, meaning way fewer taxable events for you along the way. Finally, and this might be the most important piece, they have decades of hard data backing up their historical returns. The S&P 500 alone has averaged around 8 to 9% annually over long stretches of time.
But, and this is a big but, this strategy has a pretty terrifying caveat when you actually hit retirement. Unlike the dividend investor who gets those sweet cash deposits automatically, your index fund portfolio might look absolutely massive on paper, but it provides zero regular income stream. Zip. To actually fund your lifestyle and, buy groceries, you are forced to actively sell off pieces of your portfolio to survive.
And imagine this. When the market plummets and you have no steady income dropping in to reassure you, the sheer simplicity of this strategy makes it psychologically brutal to stick with. This introduces a nasty little thing called sequence of returns risk. Basically, if the market crashes in your first few years of retirement and you're forced to sell shares just to pay your bills, you are permanently locking in those losses at the absolute worst possible time. It's in these moments that an intentionally boring strategy suddenly feels incredibly stressful. It takes serious guts not to panic sell.
All right, let's put some real numbers to this in Section 4, the $50,000 retirement test.
Let's look at this real-world breakdown. Say you need $50,000 a year to live comfortably. The index fund path requires a slightly smaller overall portfolio, about $1.25 million. This is simply because broad market funds tend to grow faster over time, and you'd be utilizing a widely studied withdrawal strategy known as the 4% rule, where you sell off 4% of your shares every year. Now, the dividend path, that requires a bit more capital right up front. We're talking roughly $1.4 million to generate that exact same $50,000 at a realistic 3.5% yield. However, the dividend path gives you the ultimate peace of mind. The cash simply arrives. You never, ever have to log in and actively click the sell button during a terrifying red year in the market.
This brings us perfectly to our final section, Section 5, Math versus Human Psychology.
As the source data clearly lays out, if we are strictly looking at a spreadsheet, the index approach is undeniably superior. Hands down. It offers lower costs, broader economic diversification, and historically stronger total returns. But here's the catch. Investing doesn't actually happen on a spreadsheet. Dividend investing often triumphs in the messy, emotional reality of being a human being. The psychological stability of seeing a tangible cash return can be the exact anchor someone needs to prevent making a disastrous emotional decision during a market crash.
So we have to ask, ultimately, what's the real goal here? The biggest mistake in investing isn't choosing the slightly mathematically wrong strategy. No, the biggest mistake is failing to know yourself well enough to avoid panic selling when things get rough. Are you truly disciplined enough to manually sell off pieces of your life savings when the market suddenly drops 30%? Or is the automated comfort of cash flow literally the only way you'll be able to sleep at night? You can't just pick the strategy with the best math, you have to pick the one you won't abandon when it matters most. So which path will you choose when the next crash comes?